Welcome everybody to the San Diego Real Estate Market Update, May 2018. My name is Lenska. I'm a real estate investor, broker, and also serve on the board of the largest investor club in California, SDCIA. We are #1 in education for investors. I know you can read a lot of blogs, news, interviews, or listen to Zillows of the world. You get bombarded with all their information and stats and their take on the real estate market, but it's also serving their agenda. My agenda is to help you as an investor make a better decision if it's good time to buy or sell and to help your bottom line. So here we're looking at facts and not the fiction. And as always, we're here to build your fortune and not fortune telling. In order to assess a real estate market and its health, we're looking at the following real estate data points: sales and inventory numbers, interest rates, employment data. Usually we talk about the Home Purchasing Sentiment Index by Fannie Mae, which is not available at the time of the recording, so I will give you my little piece of Lenska sentiment. We also look at the home builders sentiment, the affordability, and yes, it is back, NODs and trust deeds. So real estate market is really hot, flaming hot, or is there a little bit hot air? Because as you know, hot air rises to the top. The median sales price for detached homes was $640,000, which is about an 8% increase. As you can see, we had a very steep incline. It's just leveling off. As we know, last month it was a 10% year-over-year increase. How are we looking for the attached units? The median sales price is up nearly 12% over last year, and it's currently at $430,000. How are we doing on the average price per square foot, which is really increasing nearly 10% for April 2018, and we are at $404 price per square foot. The attached units, we're looking at $428 per square foot, which is a 12.6 year-over-year increase. San Diego County active listings, we are again down year-over-year about 6.4%, and we're creeping around the 4,000 mark inventory number for detached home. The attached looks slightly different. We actually have a little bit more inventory, just tiny bit, 6.5% at 1,590 units for sale. So that's kind of, and active market for detached, we're looking at 26 days, still lower. One part of why it's lower is also there's a lot of pressure on the mortgage companies to close faster because we have a very competitive market. So I have had a conventional loan funded and closed escrow within 15 days. So cash might be king, and active markets, days on market for attached is 22. It's still selling even faster than detached. Now here comes a little bit of dose of reality. We all know that interest rates went up. We're at the conventional 30-year fixed over 4.5% now. We are at 4.625. For FHA and VA, we're still at 4.25, but Good luck to all our self-employed and 1099 earners and business entrepreneurs. We still have to pay a whopping 5.75%. The only interest rate that actually went down was the jumbo 30-year fixed. Very strong in unemployment numbers. We have 3.9% in the US, and we have 3.2% for San Diego. Now we usually talk about the HPSI, which is the Home Purchase Sentiment Index, and if it's a good time to buy or sell, or if prices will go up, if mortgage rates will go up, and how confident are people about where their job and their income. The median sales price by price range gives you a little bit more insight in where the appreciation is created, where maybe multiple offers are happening. We are looking at an all price ranges. We know it's an 8.7% increase. Now, if we're dissecting this for homes up to 639, or call it 640, we actually have the 7.7% increase. Even San Diego, just above the median home price and under a million, we actually, it's the yellow line, have seen no increase over year. Now, over a million to 2 million, we actually have seen a decline of 1.3%, or my favorite price range, the 2 million or more, we actually have seen a decline of 5.5%. So, investors, if you are flipping in 650 to a million or even over a million, please make sure that you're not buying any appreciation and you can't make up your mistakes by thinking the real estate prices will go up. So who really buys and who doesn't? Everybody is talking about the millennials. I think it's fake news again. So we're actually looking at women. The share of home buyers, women, increased to 46.4% in 2017, up obviously from 18.9% in 1981. The share of single women home buyers reached an all-time high. So I think finally women get smarter and invest in homes instead in men. And it was only 9.1% in 1981. So baby boomers are buying. Households over age of 55, which increased 27.8% in 2017 compared to 16.1% in 1981. Now here comes the story. The millennials, actually, the share of home buyers right now under 35 hit an all-time low, falling to 33% in 2017. In 1981, this demographic actually sat at an all-time high of 52%. Marital status, very interesting. As it turns out, having children may be becoming less of an incentive to buy a home. Share of home buyers with children fell to an all-time low of 40% in 2017, which is down from 51.4% in 1981. Share of home buyers made up by a single-person household increased to 21.2% in 2017, up from 15.3% in 1981. So that tells you where your market is, and definitely rehabbers or people that want to sell their homes. It looks like the kitchen will be a very important feature in the home. Again, how millennials manage their money. As you can see, obviously they're still working on their emergency funds. They're saving for retirement, and buying a house is actually 33% only. The builders, Sentiment was again pretty strong, even so it has been down 5 months in a row. It's practically driven actually by lower sales expectation and especially due to affordability. Still, they have trouble finding labor and also buildable lots. And as we all know and experience ourselves, building material price increases quite a bit. So it's at 69% nationwide and it's at 76, the highest in the nation, where it is in the West. Just to the affordability, as we can see, the new median home price since 1963 for inflation adjusted has reached an all-time high. So we're right up here at $340,000, which is a average US wide. Affordability in Southern California is a different story. San Diego is obviously one of the lowest one, only Orange County is lower, and the qualifying income in San Diego, you need to make about $123,000. The lower worry about the income, which is not, or wages are not increasing, because the current median home price of 610 is taking about 5.5 times the income, where it used to only take 3.5 times the income to afford a median home price. But for the last 10 years, we have been building only 80,000 instead of 180,000, which were needed. So this will continue, especially with the higher building lots. The inventory home builders are building is for the move-up buyers. We need affordable units for seniors, for millennials, for first-time home buyers. So we still are expected to grow in California through 2015, especially in the Inland Empire, forecasted 38%, Bay Area 22%. San Diego, we're not too much in the running. Also, the problem is, what inventory are we building and is it affordable for the largest cohort right now, the baby boomers, retirees? Also look at the working age. We're only increasing it by 11%. I'm not sure how they 11% are going to pay for this big group. The problem too is the debt to income ratio. As we can see, people have been buying homes. There is some non-housing debt, which is the credit cards, the auto loan, and student loan, which is going up. As we can see, it is really hard for the millennials to afford a house, as the income ratio to the median home price is very different from under 35 to the 65 and above age group. Even the baby boomers in 55 to 64, who have lost a lot of money in the last downturn, still have issues with the median home price and qualifying and having the income for it. And as promised, I'm bringing back the NODs, or may I say the F word, foreclosures. San Diego is still down 40% year over year. Atom data solution, it has a great heat map out there. These circles you see are active, so you can Google it, and the blue circles are the size of them, the less foreclosures there are, or the red ones, the larger the circles are, the higher the start of the foreclosures. So to no surprise, we have some winners here. Las Vegas 15%, Sacramento 6%, Dallas Fort Worth 20%, San Antonio 17%, Austin 30, don't you hear in the news all the time how hot these markets are? But they also have not been appreciating as much this year than the years before because Texas does have some more inventory because the building lots are cheaper and it is a little easier for developers to build over there. Just one last note, foreclosure starts increased in 37 of the local markets. So is this enough for you as maybe the flames creating some hot air and we're seeing the top of the markets and the hottest appreciating markets in the past cooling off? Be prepared for the next real estate trend. Get the tools and to support what you need. We are here for you at STCIA. We have a great class coming up Saturday, May 12th, finding and buying properties cheaper before the competition. And to be always look on the lookout to reduce your risk when purchasing and doing the due diligence right. And Professor Leonard Barrett is teaching that class on May 19th. Thank you for listening to another market update. If you enjoyed it, you learned something, you want to know when the next one is coming up, please subscribe. If you like more education, I'm hosting 2 other events you can find on Meetup. One is called Rehab Field Trip, third Saturday of every month, which we go out in the field, evaluate properties for fix flip or possible rental opportunities. The other one is Real Estate Profit Building 1.0, third Thursday of each month. And this month we have a guest speaker talking about Bitcoin and real estate. Don't forget to RSVP and come out. And if I can help you in any way by listing or selling your properties, please give me a call. I work hard and real estate never sleeps. Thank you for listening. Always Monday in the rich man.